Okay, gift and estate tax. Okay, so gifts. So first off, what we're going to talk about here, the presentation is showing IRS rules, okay? We will trickle in some of the lending guideline stuff because that's some of the best thing about taking the class with us is that we can show you both sides. Okay, so gifts. Gifts can be used when you purchase a home, or they're customarily used when you purchase a home, or to reduce negative equity sale. The funny part about all of this is that the last few years that I've taught this class, when I say, yep, when I say reduce negative equity to sell, meaning that someone is in a short sale situation, and then their parents, in order to get them out of it so that they don't have to ruin their credit or have a short sale or whatever the case may be, they gift them monies so they can sell the house. That's what that means, okay? Prior to this year, when we would talk about that, people would say, who would do something like that, right? But guess what? We have seen so many short sales recently.
It's coming.
It's coming. Short sales are coming, foreclosures are coming, like it is right around the corner, okay? The good news is that a lot of the processes that were not in position the last time that we had mortgage meltdown, so everyone in this room that had a short sale during that time, we said it's not a short sale, it's a long sale, because you call the lender, they never call you back. Then you call them and call them and call them and call them. You wake up at 3 in the morning and you call Chase, right? Call, and they never call you back. And then they transfer you to department, and then you never get anybody, and then they hang up on you. And then you got to start it all over again, okay? Well, the good news is that during that time, most lenders developed an entire department to deal with it, right? Because they realized that there was a lot of problems surrounding that. A lot of homeowners were not getting helped. The federal government stepped in, passed a lot of legislation, and then now most of the lenders have a true solve and true guidelines and protocol that they follow, and many of them even have a department. So the good news is, this time around, it will be easier to negotiate your short sale. The difference, though, is going to be that the last time around they were letting real estate agents negotiate the short sale, right? But now it's going to have to be your borrower. Doesn't mean that your buyer. Does not mean that you can't get on a conference call with him and navigate him through it, right? And a lot of times when you're dealing with that stuff, they need that handholding because they're already so frustrated.
You can get their handwritten power to speak on their behalf.
Mm-hmm.
And I did certify as a short sale negotiator, so they will deal with you.
Yes, and that is perfect.
Were you just about to say that?
Yes, I was just about to say that.
Sorry.
Unless they give you authorization and you have the accreditation in order to deal
Which
with
is
it.
the way it was back in 2008.
Yes.
That's when I started, and that's all I did for short sales.
That's awesome. Yeah.
And if you had Wells Fargo, you were lucky.
I had Wells Fargo.
I
Why
closed
was
them in
I
21
lucky?
days. Like
Oh,
this.
wow,
Like, it was
that's
like
awesome.
a machine.
Yeah.
So I could
Yeah.
have not
Yeah.
been paying and not had to sell me. Just kidding. Thankfully,
Yeah.
that was not us.
But short sales and foreclosures are headed to us, right? So, so it will be a very interesting 2023 and 2024. Okay, so this is what I was talking about earlier, Tiffany, about the gifts, all right? For a lender, so to just answer your question, for a lender, based upon the loan comparison that we just went over, that's never going to show anywhere because what we're talking about when it comes to gift tax is IRS guidelines, okay? When your lender has you sign a gift letter, none of that is disclosed to the IRS. It's up to you to do self-disclosure. The lender never takes your gift letter or your receipt of commissions and sends it to the IRS. That does not happen, okay? Everything that we do in our loan file is confidential, so we don't share it with anyone, okay? However, that is a separate issue than gift tax itself. And when you do go self-disclose with your CPA to the IRS. Now, there are two buckets when we are talking about gift tax. The first one is replenishing, meaning that you can give $15,000 per person, so as long as it's to different people, $15,000 per person, and then we could give it every single year. So what that means is I could give every single one of you $15,000 this year.
Thanks.
Thank you.
And next year, and the IRS will not charge me a penny. Okay, as long as I'm disclosing and I'm filing it underneath the gift tax exclusion, which replenishes every year. So that's why I can do it this year, I can do it next year, I can use it the year after. However, when we see these large buckets of money being transferred, millions of dollars or whatever the case may be, there is a lifetime exclusion, which is 11 million, and this may have changed because this is a 2020, so I don't know if that number changed, but as of 2020, it is 11,580 in your lifetime exclusion bucket.
Million.
Million in your lifetime exclusion bucket. So and that does not replenish. So once you give up the 11 million, then you are not eligible to give them another 11 million unless you're married. So, gift tax examples and using your annual exclusion. So, $60,000 funds needed for down payment and closing costs. You could, instead of giving it to one person, if you take $60,000 from mom and give it all to the daughter, then technically it would not fall under the annual exclusion. You would have to use the lifetime exclusion bucket because it's too big, right? So this is just an example of how you could break it up. So mom could give $15,000 to the daughter. Mom could then give $15,000 to the son-in-law. Then dad could give $15,000 to the daughter, and then dad could give $15,000 to the son-in-law. That makes up your 60, and then you can keep it in that gift tax exclusion bucket. Okay, so that's how your CPA wants to put it together. Lifetime exclusion. Let's say that they need. So in this example, so let's say that they need $200,000. So they could do the $60,000 from their replenishable gift bucket, okay, and then the other $140,000 would go into their lifetime exclusion bucket, and then that's how you would disclose it if you gave more than the $15,000 that year to your son.
Gotcha.
Yeah. Okay, but you have to tell your CPA what you did, and then hopefully your CPA understands the two buckets, right? And then from there, that's how you would break that up, and that's how the family members who give $500,000 to their child, that's how they disclose it to the IRS so that they're not taxed on the monies. Okay, so this is breaking that out. So lifetime exclusion used is 140, and then because of this, then they would still have the 11,440 remaining in that lifetime exclusion bucket. So this is just showing you again how you can leverage the gift tax and then the lifetime and the estate tax exclusion with that lifetime exclusion bucket. So 2 buckets of exclusion, no gift tax to the recipient, okay? And then no relationship is required. So that's why I could give it to every single one of you, and I don't have to be related to you. And I don't have to explain that to the IRS either.
You
Okay?
actually can't give it to us because then we would feel obligated.
I think that's a RESPA violation.
Probably. Somewhere.
Exactly. So when we are talking about the lifetime exclusion bucket, it is unlimited to the marital exclusion, meaning that ultimately it is portable, meaning that if someone passed away, so let's say you had 24 million between the both of you, and someone passed away, husband passed away, it would then port over to the wife, and she could give that whole $22 million. Okay, it is portable according to the law now. We don't know what it's going to be in 2023, but as of 2020, that's what it was. And then, of course, remember, this is a federal estate tax, and then the states may have a lower limit. So you may get hit on it on one level, so make sure that your CPA, you're looking into that with your CPA. Oh, and then this is where they're talking about the portability, that if someone were to pass away, that the spouse could then give that whole exclusion double time. 23,160, total exclusion for a married couple using portability. Okay, now, what about loans? Okay, so sometimes parents will be so nice and they will give the money to their child in the form of a gift. And some of them will say, you know what, I don't think you earned it. I'll help you, but I'm gonna make you a loan. I'm not gonna give you free money, right? You gotta earn it. So I'll give you a loan. And so when we are talking about making a loan to someone else, and this could be a parent to a child, this could be the seller, right? Doing a seller carryback for your buyer, which is also something that's gonna start changing because now sellers are giving credits. Sellers are being more relaxed about how they approach it. The hard and fast market that we've had is starting to dwindle a little bit, and we've got the sellers that are really willing to negotiate, and some of them, based upon the type of property that you're dealing with, may be willing to do a seller carryback, especially if they don't need all that cash right now. But this is what we would have to do, is when, and this is a lending guideline, but for underwriting guidelines for a lender, if you do a seller carryback and it has, or a parental loan to a child, or whatever the case may be, if they do that, then on the application, we would have to include it as a debt. Okay, so the first thing we're gonna do is we're gonna say, okay, great, it is a loan, parents are doing it for the child, we're going to make a note, it's for, $100,000, okay? And then on that note, they're gonna have to say what the payment's gonna be. I want $200 per month, or whatever the case may be, then we would have to include it in their DTI, which is why your lender will say that if you want to gift them monies, and it's not a loan, that you have to sign a gift letter. And inside the verbiage of the gift letter, it says, and this gift does not need to be repaid, okay? And that's why your lender will generally require a relationship, because who in their right mind is gonna give $100,000 to somebody that they don't know, right? Unless it's a loan, right? And I'll tell you a very real story that happened using this type of a situation was, I had a young couple, they were both school teachers over in Kaneohe, and they got married. And the husband's family had a substantial amount of money. So they wanted to buy a home, they wanted to buy $1 million home, and they could only qualify for $500,000. So the husband's parents gave $500,000 to the couple so that they could go buy their house. Ends up, unfortunately, that the wife ends up divorcing the husband. And so, of course, the family comes after her and says, well, then you've got to give us the money back because we bought the house with the $500,000 that you took from us. Well, she came forward with the loan documents and said, you signed this letter that said that you gave it to me.
Oh my. Oh yeah. Oh yeah.
Right? Because in a legal
gross.
aspect,
That's
even
sad.
though it is, and she cheated on him too, which was even worse. So she cheated on him, divorced him, and walked away with $250,000 of his mom's money. Like, how big of a slap in the face can you possibly have, right? So very painful, but just let you know, he married somebody else, they've got 2 kids, and he's super happy. So it worked out great. So sometimes it's worth the money, right? Why is divorce so expensive?
Yeah.
Because it's worth every penny.
It's worth
Right?
the less.
How much is your freedom worth, right? How much is your freedom worth? So, but that is very real. And that is a space where something that was implemented in a loan document that she happened to carry, because it was in a written format, she was able to use in the court of law. So, these things have ramifications, right? So, but what I can tell you about lending guidelines is that Fannie Mae and Freddie Mac did open it up a little bit, so now it's not so hard and fast that you have to be a family member. They are taking into consideration that you could be unmarried partners. They are taking into consideration that you could be fiance and fiancé, and that you could be like Hanabata brothers, that maybe you want to help each other. Or a Hanabata auntie, or whatever, right, Calabash auntie or whatever. So they are taking into consideration some of those things, but this is the reason why you have to have them sign the gift letter if it's going to be a gift, is because if it is a loan with repayment, it could affect the way that they qualify for the loan. Okay, IRS guidelines, if they are making a loan, so remember the topic of this is that we are talking about them making a loan. So if they make a loan, the borrower must pay interest on the loan. So they would have to lay out, just like on any other note, when you take a loan, you know, if it's secured, what it's secured against, right? What the amount is, what the interest rate is, and we see this a lot on seller carrybacks and things like that. They could actually say, and there is no payment deferred for 12 months or whatever the case may be. So they could put that verbiage in there. I did have a situation once. It was pretty funny. The mom had given money to her kids. Different family than what we just talked about, but the mom had given money to the kids. They did make the loan, and they made a forgiveness clause that said that as soon as they get their first grandchild, that they would forgive them. So you can't hold them hostage, right? For collateral. It doesn't have to be secured against a home or a car. It could be for grandkids.
There is different consideration.
Exactly. So when you write the note, you can put whatever it is that you want in there, as long as it meets the rules. So, is the recipient of the money paying the applicable federal rate? Applicable federal rate, and you were talking about this about the usury laws. Right now, it's about that 13% or below, which is why if your client is going for the hard money loans, right, or the private money loans, they're generally between 10 and 13%. In fact, we work with some hard money lenders right now, and the going rate is right about 11%. Which the reality of it is especially if you're using a DSCR, investor loan debt service coverage ratio. So what that means is instead of qualifying for the payment the way you traditionally would, they use the cash flow from that property in order to help you qualify. So in that space, your rate could easily be 9 or 10% anyway. So 11 or 12% to get a easier loan with no documentation, stated income, stated assets, could possibly be the way to go, especially if you've got a customer that is really challenged, right? I mean, we just closed a loan, believe it or not. The guy was self-employed, but he didn't have a business license. He was, his tax returns were nothing, right? He was showing that he made like $10,000 the entire year for the last bunch of years. He had no credit score. Yeah, he had credit in the past, but because he didn't use it, he was a contractor, landscaper. He just didn't have a score that was generated. And then,
Cash business.
And then most of his monies were in cash. But what he, at his house. But what he did do was just sell a property, which gave him about $150,000 in California. So we were able to get him a hard money lender, a private money lender. He did close on that house. In fact, this morning I got a long-winded voicemail from him about how much he loves the view and he can't believe it and his dreams come true. And so many people told him no. And that interest rate was 10.75, but he has a home in Hawaii now where he never would have been able to do that before. Depending upon what kind of a private money or hard money lender you use, the terms could be 1 to 3 years. And this one happened to be 3 years. So he's got 3 years to get his stuff together and for us to figure out how we're going to refinance him. So that was actually one of the things that I did this morning. I put him on the books for January 15. He's going to come to the office. We're going to start working on his credit now so that 3 years from now he's ready. Because the last thing that you want to do is have a situation where they are taking what we call the Band-Aid loans, right? And that's how we always talk about them. This is not a permanent loan. It is a temporary interim Band-Aid loan. It's to get you from one place to another, but you have to have an exit strategy. You have to actually do the things that you need to do to get out of it. We had a situation like that not too long ago where there was a couple. They had done a rent-to-own in Kailua, and they contracted that property at like $400,000. And this was many, many years ago.
Was it
I would
an
say like
option?
10 years ago. It was a rent-to-own option. Yeah. And so they had 5 years. And they called me 6 months before their 5 years were up, and they had done nothing in the last 4.5 years to fix their credit, work out their income, get pre-approved, nothing, okay? And of course they had gone to a number of lenders and they told them absolutely not. So, of course, and their real estate agent referred them over to me, and I looked at the mess and I said, oh my gosh, in the last 5 years, you know, you didn't do anything to put yourselves in position to refinance. Well, that seller, they were like, well, maybe we can go back to the seller and get an extension, but she said,
No.
absolutely not,
Oh,
because
no.
the values were already 800,000.
Of course.
So the seller
They were
was
hoping they
sitting
would
there.
default.
Yeah, they were waiting.
Let them default, we'll take the money back and we'll go ahead and double up the property. And sell it again.
Exactly, and she was sorry, right? Because she had, the seller had put together that contract right in the, you know, meltdown when everything was falling apart, and she thought that either she could get this renter and make the sale right now, or she was going to be bust. She never thought in her mind that, you know, 5 years
double
from
up.
now, that they would be double in value and the market would rebound as strongly as it did, especially in an area like Kailua. And I want to say it was like not, you know what, where like Kalama Beach is. Okay, so not on the beach side, but like the street over there where everybody
is
parks.
still great.
Which is unbelievable. That's actually better because then you don't have flood insurance. But anyway, so yeah, so we fought tooth and nail. We scooshed right in there with like 3 days to spare, that kind of a thing. And they were so, we had to repair her credit or help her to fix her credit. And then we had to perform the loan transaction and do that whole shebang. And I think we even needed to get some gift funds because she didn't qualify for the whole thing. But we pulled it off, and she was able to keep that property.
Yay.
Oh.
Yeah, it was crazy. It was crazy.
That's a
I
great
have a similar
success story.
thing for you soon.
Yeah, absolutely. So
That seller is crying now.
exactly. So the seller was
Darn
crying.
loan officer.
Yeah. Miracle workers. What are they doing?
I don't wanna leave.
And then, so that is the child, this is in the event of the grandson, right? A prearranged plan to forgive the loan.